Let's get to the latest news out of Washington now, where my next guest is warning that we face a looming government shutdown. It could not only take a bite out of GDP, it could also affect what the Fed does with rates in the next couple of meetings. For more, let's bring in Alec Phillips, chief U.S. political economist at Goldman Sachs Global Investment Research. Alec, good to see you.
Thanks for having me.
So how much are people talking about this already, do you think? I mean, are we already at more than 50% odds of a shutdown?
Well, I think so. I think it's more likely than not. I think the problem at this point is it's a little hard to tell when it will happen. They need to pass spending bills by October 1st. But, there's a chance that they could do a temporary extension. You look at shutdowns in the past, they haven't all started at the beginning of the fiscal year on October 1st. But I'd say, I think the view in the market is that the odds are rising, and I think the view in D.C. is that the odds are rising.
And one dot that we were just talking about with Brian Reynolds, kind of connecting all of this, is that the Treasury is trying to raise funds, it sounds like, in anticipation of a shutdown, and that's, right now at least, creating some upward pressure on yields.
So I think the shutdown is related to the Treasury's financing needs in one way, which is that the deficit is very large. So the deficit right now is probably running a little bit more than 1.7 trillion, in terms of the current fiscal year. And that's a big increase over the prior year. And I think it's something, particularly along with, the Fitch downgrade recently, something that's gotten a lot of attention among particularly conservative Republicans in the House. And so, in addition to the usual kind of controversial political issues, you actually have an underlying disagreement on spending levels, which I think is just made worse by the fact that the Treasury is running the kind of deficit that they are.
How bad is the spending position? When I look at the debt numbers in particular, and you sort of know, okay, it's going to be an overhang for 5 or 10 years, but maybe we can just Japanify our way out of it, right? Like if interest rates go back to low levels, maybe there's no problem. If they stay up here, it seems like no matter what, we will face a problem.
So, interest expense is almost certainly going to rise, in part just because, even if the Fed cuts rates, even if rates normalize versus the historically, high levels that we have right now, ultimately, interest expense is still going to rise as what the Treasury pays catches up with the market rate. Because, of course, you've got 5-year notes, 10-year notes, 30-year bonds that won't mature for a while. And when they do mature, they're going to mature at a higher rate. So we know that interest expense is going to go up. I think where we're in sort of uncharted territory is the fact that it's likely to rise beyond, probably the historical highs that we had in the late 80s, early 90s. And if, for example, you have, let's say, 5% rate across the curve, when you have 100% debt to GDP ratio, you're going to have 5% of GDP going to interest every year. And that ultimately, I think, is going to force some decisions. But it's not going to be an issue in the next couple of years in terms of ability to pay or anything like that.
No, it's amazing how much a difference. If we could get rates back down to 1%, suddenly this seems like a much different. If only we could have a recession. I don't even know if that would do it when they look at the fiscal picture.